Hello, everyone, and welcome to the Inside ETFs weekly webinar. My name is Matt Hogan, and I'm the CEO here at Inside ETFs and your host for this weekly webinar series. In today's show, SSGA's fee cuts and the future of ETF investing. When SSGA announced this week that it was slashing fees to match or beat all competitors on 15 core beta exposures, it stood the industry on its head. SSGA had to some degree steered clear of the ETF fee war, letting BlackRock, Vanguard, and Schwab duke it out in a limbo dance to zero. But now it's planted its flag in a major way, and in today's show we're going to ask, what does this mean for investors? What does it mean for the ETF industry? Can anyone make money with fees these low? And where do we go from here? Here to join me is an absolutely amazing panel of experts. Eric Balchunas is an ETF analyst for Bloomberg Intelligence and one of the smartest, sharpest, and funniest ETF analysts living today. Ben Johnson is Director of Global ETF Research for Morningstar, where he directs probably the most important ETF research group in the world, puts out great content. And Todd Rosenbluth is Director of Mutual Fund and ETF Research for CFRA, widely respected in the space, a huge friend of Inside ETFs, and he puts out some of the best daily and weekly commentary on the ETF space. I read it religiously. But that's not all. We also have Nick Good. Nick is the co-head of Global Spider, here to participate in our 5 questions in 5 minutes segment, giving us a first-hand view of what drove these cuts and what it means. And Jay McAndrew, VP and National Sales Manager for Strategic Beta at Columbia Threadneedle Investments, to talk about a new fixed income ETF that provides an interesting solution to investing in rising rates and almost coincidentally currently charges 0 in fees. So it's one heck of a show. It's the Inside ETFs weekly webinar, and we're going to get started with Nick Good. Nick, the way this segment works is we have 5 questions I want to ask you about the news. We have exactly 5 minutes to answer them. So first, welcome to the show. I'm going to start the timer now. And my first question is, after a number of years watching this space, watching the fee wars develop, why cut fees now?
Thank you, Matt, and thank you for having me. It's been a fantastic week. It's not often every single one of your clients is telling you how happy they are. So hopefully it'll happen for a while. Clients have been asking us this for a long time. This was something we are consistently being asked about, and their reasoning was simple. They felt they had insufficient choice in this space. They didn't want to use providers that compete with them, and we're very much a party that is focused on the advisor and putting the advisor first, and that left them with very little choice about where they go. So this was something we'd been asked to do. The challenge we'd seen is, if you launch a illiquid fund with limited assets into a market that's already well established, you're not going to succeed. No one's going to buy you. So we had for some time felt that we needed a strong value proposition, preferably with a partner, and the ability to launch in size and with liquidity. And so the why now piece really comes from TDA. We've spent probably the better part of the last 6 to 9 months working with TDA as they revamped their commission-free platform to provide these spiders as the centerpieces of that platform. We obviously re-geared them not just in terms of price, but also to line them up for a retail audience with things like the share splits to get them all to about $30 a share. But it really did sort of mean that we now had, by using existing funds, I think there's about over 11 billion in assets across the full range. They're all trading, they're all liquid, and so we have a really compelling solution. We have low-cost funds that are already at scale, they're already approved on TDA and on many other platforms, and it's an offer that actually can stand on its own 2 feet day one.
Yeah, it's a really impressive lineup and really great funds. What are the actual economics, though? Are you losing money with products priced this low, or is this still net business positive for spiders?
So it is actually net business positive overall. I mean, we will take a small setback at the start, but the reality is we spend a ton of time and a ton of effort reworking the entire sort of underpinnings of these funds to get them down to price points in terms of the cost that work. So the majority of the fee give up we've actually saved back in sort of cost savings. I've learned more about the printing of prospectuses than I ever thought I would. But as a result, these cover their costs, they cover their variable costs, they're profitable day one, and we have with any kind of growth expectations, they'll make up the marginal loss of revenue pretty quickly.
Brilliant. Is this the future of ETF distribution? Are we going to see more deals like this, particularly with the wires, where distribution is getting a little bit tougher in the ETF space?
I don't know. I mean, I think the key thing here is there is a certain total cost of ownership to every investor, and whilst that varies depending on the type of investment you're making, the size of it, and so on, as management fees get lower and lower, actually, funnily enough, commissions become more significant. So, TDA was the first into the commission-free marketplace. But that in that space, because this is very much about the RIA support model, which we're really focused on the sort of custodial side of TDA's business. They've been followed with Schwab, obviously, and Pershing and RBC, and these funds actually, most of these are already available commission-free on both Pershing and RBC. I believe that you'll continue to see competition around commissions. It becomes an important part of the overall ownership structure, and I think it'll be hard for national broker-dealers to be impervious to that.
For sure. We got about 1 minute left. One thing that was notable was TD booted Vanguard from its platform to make way for these funds. I don't know if you'll answer this, but is there like a anti-Vanguard kickback or rising among advisors concerned about personal advisor services? Is there any element there that's happening?
Look, I think advisors have always had a conflicted and complex relationship with Vanguard. I mean, it's a wonderful brand that a lot of end clients, investors love. But the more they're challenging a core advisor's business, the more conflicted an advisor is going to be about using a Vanguard product.
Fair enough. Last question, 20 seconds. Are we going to see more funds in this portfolio, or is it 15 and done?
So we made an intentional decision to be as bold and comprehensive as we could on day one, so that we wouldn't get into a fee war, so that we wouldn't be adding to it. But I'd be lying if I said we haven't already had a list of other ones that we've been asked to look at. So we don't have any plans to do so, and anything we do will be highly selective. But I won't say never say never.
All right. Thanks so much, Nick. Thanks for joining. Thanks for doing good things for investors. Appreciate it. We're going to bring in the roundtable with Todd, Eric, and Ben to talk about these fee cuts from an independent analyst perspective. But first, I do want to bring in Jay McAndrew. Jay is the Vice President and National Sales Manager for Strategic Beta. We have a segment in these webinars where we introduce listeners to a new ETF that we think is worth considering. So I'm going to hand the mic over to Jay for 5 minutes, and then we'll bring in the roundtable after that. Jay, take it away.
Great. Thank you so much. First, congratulations, Nick, on a great announcement. Thank you, Matt, and good afternoon to everybody. As you all know, the ETF environment continues to evolve, and I'm excited to introduce DIAL, the Columbia Diversified Fixed Income Allocation ETF. It is the first passive multi-sector bond ETF, and we are launching DIAL to help investors address a need, and that is to get more income from their fixed income. Matt, I would just ask you to move to the next slide. I think we all understand, there we go, great. We all understand that the fixed income landscape is changing, and after 40 years of falling rates in which the 10-year Treasury returned 8% annually, an equity-like return, the new rate regime has investors rethinking their fixed income approach. Additionally, a low yield environment has investors flocking to lower cost solutions, many of them both active and passive, which track the Barclays aggregate index. And the aggregate index is an exposure that rewards indebtedness, meaning that the more debt a company, or in this case the country, issues, the more representation it has in the portfolio. And we don't know that that is the most rewarding way to structure a portfolio. So today, the ag is about 70% in both government and government-related securities, and that concentrates its risk really tied to duration and interest rates sensitivity. So again, we don't think rewarding issuance of more debt is the best way to invest in fixed income, but we do believe in diversification because it's prudent, and building portfolios focused on opportunity rather than indebtedness makes a lot of sense. On the next slide, we can see correlations of different fixed income sectors to one another. Just as we know in equities, diversifying can reap benefits, we also think there is a power of diversification within fixed income. You can see the high correlation, circled in red, of the U.S. Treasury and the mortgage-backed sector, again, which make up a majority of the ag exposure. Conversely, you can also see the lower correlations, circled in blue, when you use a multi-sector approach. Moving on to the next slide, I just wanted to introduce at a very high level our strategic beta approach. So again, DIAL is a multi-sector bond strategy, and it was designed and is managed by Gene Tenuzo, who also runs our active 5-star Columbia Strategic Income Mutual Fund. DIAL has exposure to 6 sectors in the fixed income marketplace, and the weights of those sectors remain static. Gene used his experience to build a rule set to help increase yield, but also focus on quality and liquidity. What did we do for yield? Well, on the left-hand side of the slide, you can see some of the things that we did. We excluded short-term government debt that has limited yield. We excluded non-government securities with limited risk premiums. We excluded negative yielding debt. So we were trying to take bond exposures and make our bond portfolios better than what conventional indices offer relative to yield. We did the same thing on quality. A few examples. We don't buy any corporates rated below single B because default risk really increases, and we don't use any sovereigns rated below double B because you incur, in our opinion, too much political uncertainty. So those are the things that we did to try and make this a strategic or smart beta portfolio. And what I would ask you to do is just move to the next slide to give you just some of what the portfolio looks like today. On the right-hand side, you can see how the portfolio is allocated. On the left of the pie, we see in green, 30% of DIAL is allocated to high yield, 20% is allocated to dollar-denominated emerging market sovereign debt, and those two categories help us increase the yield output of the portfolio. But you see the balance on the right side with quality, 15% in both investment grade and mortgages, and 10% sleeves to global and U.S. Treasuries. On the left-hand side, you can see that the yield target is about 3.47%, about 125 basis points more than the Barclays Ag. And as Matt had mentioned, we think the fee is very cheap at 28 basis points. But for the first 90 days since launch, which was last Thursday, October 12th, we've waived the fee till zero. So DIAL has no fee until January 13th, 2018. And so to summarize, DIAL is the first multi-sector passive fixed income portfolio. It is a balance between yield, quality, and liquidity. It is attractively priced with a 90-day fee waiver. And finally, it was built from our active success and our active insight. So Matt, with that, I'll turn the call back over to you.
Thanks so much, Jay. Really appreciate it. We do highlight one ETF each week we think people should look at. DIAL certainly qualifies, solves a big problem, well constructed. I will say it has a great website. So if you Google DIAL and go to the Columbia website, there's a lot of great resources there. So thank you, Jay, for coming on board. I do want to bring in the panel here. Todd Rosenbluth, Director of Mutual Fund and ETF Research for CFRA. Ben Johnson, Director of Global ETF Research for Morningstar, and Eric Balchunas, ETF Analyst for Bloomberg Intelligence. Let's start with these new SSGA funds and specifically what these fee cuts mean for investors. You know, this news gets shot out across the market, Todd, and should people switch? Like, what should people be thinking about when they see these big, new, cheap, say, emerging market ETFs hit the market?
Yeah, so let's take the commission-free aspect out of it because every brokerage platform or every discount brokerage platform has something that's there. So if you owned these ETFs, then obviously cheaper being better. That's always a good thing if you already liked it for what it is. But you really need to consider other factors. So if it's tracking an index that's identical to something else that you have, then you want to also be cognizant of the bid-ask spread that's there and how well are the trading costs, total cost of ownership came up earlier. But if it's tracking an index that is different, and so SPYD, the high dividend yield ETF that State Street now offers, it's now cheaper than Vanguard's product, VYM, but it's also lagging behind VYM by 600 basis points this year. So the 5 basis point savings you'd get really doesn't offset the performance difference, and what's really different is the underlying holdings. And so for the sake of time, I'll stop there just to say that ETFs are not apples-to-apples comparisons. You shouldn't just buy the cheapest product. You really have to go deeper than that.
Well, that's definitely true. Go ahead. Yeah, jump in.
Matt, this is Ben. So I would echo much of what Todd said. So if I'm an existing investor in some of these ETFs, and notably in cases like the Spider Portfolio World ex-US ETF, which saw its fee drop from 34 basis points to 4 overnight, I might be sending a fruit basket in the mail to Nick Good and team today, thanking them for making that investment substantially cheaper. But what matters more in the grand scheme of things as we do this, as you alluded to earlier, limbo towards zero, is that every BIP amounts to $1 in savings with respect to fees on an annual basis for a $10,000 investment. So the savings are less and less over time, and in switching in many cases would be folly. I think looking at total cost of ownership more holistically and more importantly yet, understanding the exposure that you're getting yourself into are paramount now that fees are reaching this sort of near zero levels.
Right, for sure. But, Eric, don't the commissions matter? I mean, both Todd and Ben sort of set them aside. But isn't that important, particularly for retail investors, if they're TD customers? Shouldn't that be an even more dominant factor, perhaps, than the index itself?
Well, the commission on trading, that's almost like a mini, tiny front-end load. It goes away the more you hold it. I think the expense ratio should be somewhat king because it's coming rain or shine, and that's what really has plagued active funds for a long time. But when you get down to a basis point here and there, I agree with both Ben and Todd in that I don't think people will switch. I think they're going to agree with what those guys just said. I think new investors is what these are going to be attractive to, because there clearly is, the phrase I use is expense ratio is the new past performance chart. It's the first thing people look at, sometimes before even exposure. And so when they go to invest now, and if they have any relationship with Spider whatsoever, they're going to like that this is the cheapest one on the market, even if it's 1 basis point. And the proof is IVV. It cut its fee a year ago now. It's been a year since it went from, I think, 6 or 7 basis points to 4. So it was 1 basis point below VOO. In that last 12 months since it did that, it's taken in $32 billion. VOO has taken in $13 billion, and SPY has lost $2 billion. So I get why they're doing it. That's where the money goes.
Right. What do you guys think about that?
To Eric's point,
yeah.
What I would just add to that, Matt, is that simultaneously there's a limbo going on with commissions too, right? So ticket charges have gone from $12.95 at full freight to $8.95 to now $4.95. So the appeal of commission-free grows less all the time as you see a sort of ticket charge limbo taking place concurrently with this fee fight in ETF land.
So, Ben, where does it all go? If we're going to zero on expense ratios, we're going to zero on portfolio charges, right, from ETF strategists, we're going to zero on commissions. Is there any money left? Are we all going to pay, hidden fees? How does the industry survive? What does it look like in 5 years?
Yeah, so, keep in mind, if you look at just on a run rate basis, what Spider's foregoing with these fee cuts is about $11 million or so in run rate fees. That's scaled against a base of more than $1 billion in fees across the broader Spider suite. So you're talking about a percent or so of run rate assets. As Nick alluded to earlier, maybe they're going to rethink and sort of realign their cost basis, kill a few less trees by sending less paper prospectuses out in the mail or something of the sort to their end investors, it's going to go lower. You're going to see these pay-for-play platforms continue to grow. As you see in Schwab OneSource, as you see now in TD and elsewhere, the costs are still going to be there. They're not going to go away. What I would argue is both today and into the future, the real sort of front that deserves attention in this battle is at the level of model building and ETF portfolios. So it's no coincidence that portfolio is now in the new names of these ETFs because they're intended to be used by ETF model builders. And you see a tremendous amount of growth there. We've certainly seen it over the course of the past 5 and 10 years. I expect that you'll continue to see that space and that activity only grow in importance in time, and ETF providers themselves will continue to rise to prominence as some of the largest ETF model builders and not just raw material providers.
Right, but aren't those fees getting hammered as well?
Well, that's absolutely the case. In some cases, the ETF providers are in a very advantageous position relative to independents, given that they own and they supply the raw materials. So they can earn their keep collecting fees on the underlying ETFs, whereas an independent would have to levy a fee above and beyond that.
Matt.
Yep, go ahead.
Yeah, I just want to jump in on this real quick because I think what you're talking about is, and you say 5 years, and I think it's a long time. I'm a little more drastic than Ben, I think. I think beta will be zero. I think you have your world's cheapest ETF portfolio. Right now, you can get fully exposed for 0.06%. I see that at 0.01, 0.02, at least, if not zero. And I think that the way it's going to work out, like State Street is in a very good position because they have what I call diamonds. They have a couple dozen ETFs that trade over $50 million a day. They're used by institutions who don't care what the fee is. And those are going to continue to generate revenue. And if you have a highly traded ETF, you don't have to play this fee war game. And so I think and this is what iShares showed with not lowering EEM, but lowering the rest. You'll see some deterioration on those highly traded ETFs, but it'll take 10 years to wipe away that liquidity and volume. So I think that's probably where we're going. You have to find different ways outside of beta to make money as an asset manager.
Right, but Eric, that's not a growth story. That's a sort of clinging on story, isn't it? Like you're protecting those fees as long as you can.
I mean, why not? I mean, that was, when the core came out, I think that was a game changer. And now we see why. EEM, even though Todd will probably tell me how much IEMG has taken in since it came out, EEM still has $38 billion. I think it's iShares' most profitable product, that or EFA. Even though it's probably might be in the fifth or sixth largest. So the point being is, if you have a highly traded ETF, which to me is like beachfront property in the future, whereas everything else is getting lower, smart beta, active, and regular beta, these ETFs that trade a lot are going to be very valuable. And then obviously the Schwab model where you can use your assets to do other things, and then iShares uses securities lending. Those are going to be, I think, the new ways to generate revenue to keep everybody getting free exposure.
For sure. Let's talk a little bit about smart beta, because part of the bet here, and this is both on the platform side and the issuer side, is that you can have a handful of plain vanilla free funds and then charge up the wazoo for more esoteric exposures. But Todd, is it really true that smart beta can be protected from the kind of sort of violent fee depression we've seen in the core beta space?
Well, we've seen it. So PowerShares came out with a minimum volatility slant to the S&P 500, which was cheaper than their very successful low volatility product, and a couple of basis points cheaper than the iShares minimum volatility ETF that it clearly is designed to be a S&P version of. It's now 13 basis points. So the SPLV 25, USMV is 15, that's 13. Now, it hasn't gathered the assets to show you that brand and longevity of a product can matter a lot more than perhaps a provider may think of it, but fees are coming down everywhere. And again, especially in smart beta, to repeat myself, there's nuanced differences between the products, where your S&P 500 growth is the same thing regardless of who it is, or your Barclays, or sorry, excuse me, Eric, Bloomberg Barclays ag-based product is the same essential product. Smart beta strategies are going to differentiate themselves on the rules, and the performance records are going to be different from one another. So they can compete on the product that's inside it, not just the fee. But I think they're going to continue to compete on the fee because that's the easiest thing to do, is bring your pricing down.
Right. And Eric, those numbers in the last 5 years are $33 billion in inflows into IEMG and $2 billion in outflows from EEM. So it has been a low-cost story, but you're right, EEM is hanging on. Ben, do you think smart beta can sustain a pricing premium? Because that's certainly been a thesis that's driven a lot of traditional mutual fund players into the ETF space.
Yeah, I'm highly skeptical that that'll be the case, Matt, especially as many of these funds have longer records and continue to jockey for position and position themselves, at least at the start, against active managers where they have a very meaningful fee edge, but in many cases they're still charging multiples of what dirt cheap bulk beta building blocks are asking of investors. So I think the pressure will continue to mount. Todd alluded to some examples where we've seen fee competition already. Certainly right out of the gate, we saw Goldman Sachs with its active beta suite and its U.S. large cap active beta ETF, get some people quaking in their boots because most U.S. large cap smart strategic factor oriented, whatever you want to call it, beta strategies have nestled into this cozy little neighborhood of somewhere between 20 and 40 basis points in terms of the fees they charge, and all of a sudden Goldman came in and basically short sold their house in a neighborhood of multi-million-dollar homes. It made people nervous. And it's difficult to justify, in my mind, just from an economic point of view, if the incremental cost of developing and maintaining a so-called smart index is by any stretch of the imagination comparable, if not marginally greater than that to calculate the S&P, what really can justify a sustained premium for these strategies? It's a difficult question for me to answer.
I would jump in if I can here, also just because it's coming, and you may have a separate webinar on this, but Vanguard is coming out with smart beta strategies, and Vanguard has not been shy about bringing pricing competition to the overall marketplace. They've done it. In fact, the fact that this is happening is in part, as Eric, I'm sure, will use a verb and adverb and every other punctuation for using Vanguard. What we're seeing here is that Vanguard's coming in soon, and everybody's got to be ready for it.
That's definitely true. Let's close with yeah, go ahead, Eric, and then I'll have my closing question. Go ahead.
I was just going to say, high active share smart beta and high active share thematic ETFs, I think, is a way to carve out a little bit of a living. Robo charges 95 basis points. No one cares because it's up 30% over the market. So if you can really hit home runs and you have your year or two in the sun, I think you can get away with a higher fee. I think that's the other little niche that can make a little money.
Yeah, I think I'll say I agree with that, and we've seen First Trust stick stubbornly to what appear to be high fees, but still go on great asset gathering tears following good performance. I want to wrap with a question for each of you on Vanguard, because the explicit piece of this was Vanguard got booted out of TD, and State Street got put in. And Nick mentioned it, that advisors have an uncertain relationship with Vanguard. Todd, I'll come to you first because you tweeted about it while Nick was saying it. What are your thoughts on that relationship with Vanguard? What are your thoughts about how Vanguard will play in this new era of sort of pay-for-play distribution in the ETF space? Will it impact Vanguard's growth? Give me your 2 cents.
So, in short, I don't think it's going to stop Vanguard whatsoever. Respectfully, we've been in a pay-to-play world in the ETF space for the most part, and Vanguard has continued to gain market share. They're going to continue to launch smart products, be prudent with the asset allocation strategies. They're among the cheapest products around, and the costs are going to continue to come lower. I think that they're going to do very well, even though they're not on this commission-free platform. You can buy it directly from them. You can buy it and just pay the commission, which is, as was mentioned earlier, has come down quite a bit. So I think an advisor that has built a model using Vanguard is not going to necessarily switch to State Street just because it's commission-free on TD Ameritrade.
Ben, do you see, hear, feel pushback from advisors against Vanguard because of the success of personal advisor services?
Nothing that I've heard directly, though it certainly is intuitive why advisors might be feeling threatened by the growth of that particular channel, because it's been on an absolute tear and has been tremendously successful. I don't believe, however, that the fact that Vanguard has never broken with its discipline and won't certainly now with respect to not engaging in pay-to-play arrangements is going to have any real effect on its trajectory.
All right. Eric, last question on Vanguard. Any thoughts on whether not paying to play, which is a Vanguard motto, is going to limit its growth in the ETF space?
I'm with these guys. No, this is a tiny little blip in Vanguard's history. I think you're also not trading Vanguard, so to buy it, pay the commission, I doubt you're going to go out of it like 3 hours later. So that's one thing. The other thing is just I find Vanguard fascinating in that they're getting into, as you said, the advisory service. You know, a lot of people charge 1%. Everybody's worried about robos. It's not. It's Vanguard, because they're going to provide human advice for robo fees. They get the best of both worlds. And I can see why advisors are nervous. They should be. Vanguard doesn't have a profit motive. It's a highly unique company in a very profitable type industry, and they're going to go after quants with their smart beta stuff, advisors, and those areas have just begun. And I just think it's going to be like Amazon to the retail in the malls.
I love it. Okay, closing question, quick round table. 5 years from now, Eric, what will I pay for total U.S. Broad-based equity exposure in terms of expense ratio?
0.00. That's an easy one.
There you go. Ben, what do you say?
Yeah, if anything, you might get paid, and in some cases, you know, if you take into account just portfolio management practices and revenues from sec lending, in some cases, you're already effectively paying nothing to own the U.S. market.
That is true. Okay, Todd, last word. Will we be at 0.00 for U.S. equity in 5 years?
So I think it'll be slightly above that, fractionally above that, but the trading costs are going to be there. So whoever moves first, if they do so with a product that isn't as liquid, you're going to see the bid-ask spreads be wider right out of the gate, and I think that's important for people to consider. It isn't just the expense ratio. It isn't just the commission. You really understand the trading costs tied to buying an ETF.
I definitely agree with that. Really thank each of you for coming on. Each of these gentlemen is worth following in their written research, in Twitter, and everywhere they speak or talk. I love what they do. Thanks to everyone who joined from the audience today. I think this is a critical topic. It was great to pull together this great panel and see where this goes. I think that my takeaways are this move is good news for investors. It lowers fees, but it's more about new money than it is about switching money. And if you are going to switch, you have to pay careful attention to the ancillary costs. But long term, I think it's still safe to say this is the greatest moment ever to be an investor. You can get a better deal than you can in the history of investing. So exciting times. I hope everyone will join us again next week for our weekly Inside ETFs webinar. We'll have another hot topic coming at you just like today. Thanks very much, everyone, and I'll see you all next week.